Traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a quick look at the disclaimer, or a couple of disclaimers actually that I need to show you, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers or sellers relate to in order to enter and exit markets. These can be stories or narratives which are long-term fundamentals, short-term technicals, or short-term themes that increase and decrease in importance over time. While I just finish off with this last disclaimer, our goal really is to break down all the market jargon and complexities that you do read about. So if you do have any questions, please do ask them along the way, and I'll be happy to help, or at least after the webinar finishes. Okay, it's Wednesday, January 14, just after 11 a.m. in London. So let's get to it then. We'll follow the normal format. So we'll just check out how markets are trading currently. We'll then look at some of these themes that are important at the moment, and then we'll go into a review of the key data points and all the associated currencies and technicals and charts that are associated with these areas of the market. Currently then, really interesting. Markets currently, dollar slightly off, gold and silver making record highs again, FTSE 100 making a record high, so stocks in Europe fairly pretty much in the green. The Japanese Nikkei hits another record high after speculation, or now not even speculation, but there are snap elections in Japan. We'll get to that shortly as well, because that's a little theme which has been driving dollar yen higher, so the yen weaker on the Takaichi trade, and as I say, we'll get to that shortly. As for the market theme around Fed independence, that hit our screens really over the weekend after Fed Chair Powell, the current head, was served with grand jury subpoenas relating to his testimony, and also really the renovations of the Fed headquarters. Just for your guide, this was quite an incredible series of events, as Powell really did push back against this, and he indicated that the move should be seen in the broader context of the administration's threats and ongoing pressure. Quite a forceful reaction really, and really a clear escalation in the fight on central bank independency. What we've seen since then is 11, I think it is, other heads of other central banks backing Fed Chair Powell, and also former Treasury secretaries in the US, and also Republican senators as well, really not happy with this scene of events and the questioning potentially of the independence of the Fed. A very strong reaction, and really that pushback has seen the reaction to the events, the initial reaction really with the dollar off, the mild sell America theme really, US equities down as well, Treasury yields adding basis points, 3.5 basis points at one point, and of course gold hit an all-time high on the Monday, of course, and then we carried on going with that. But we did get other safe haven assets like the Swiss franc outperforming on that. That's probably a longer term theme about Fed independence, but really it did bring it out into the open with these with Fed Chair Powell being served, as I say, grand jury subpoenas. Bond curve for us will be the key determinant there, really, the short end, which moves sort of Fed interest rate cuts, whether the market prices in more cuts or further out in the long end, then potential stress signs on independence risks. We haven't seen that yet. As I say, the pushback has seen markets fade those initial moves really, but it is something to keep an eye on. The other thing, well, along with the new head of the Fed, which we'll get to, is obviously a lot of geopolitical events at the moment with Iran, with Venezuela, Venezuelan oil, Iran and oil as well, the supply disruptions there potentially, Greenland, of course, So all sort of hanging in there along with, or front and center actually, along with then lingering uncertainties around potentially the pending ruling, of course, of the US Supreme Court on tariffs, and also then the announcement of the Fed chair. I wanted to add as well a couple of other points from President Trump, really, new policies as we get into the midterm elections and the build up to that. They're not till November, but really it seems that President Trump has started with alternative policies really to try and appeal to the electorate really, and the cost of living really, which is an issue potentially still. So a couple of things here. President Trump demanding credit card companies cap interest rates at 10%. That's down from, I think, an average of 22% in recent years. Lenders really arguing that such rates are to compensate for the lack of collateral where borrowers default, and warn the rate caps could result in reduced credit availability. President Trump set a deadline of January 20 to comply, otherwise they would be in violation of the law if they didn't. Many questioning what that law is actually, and whether there is any law about what credit card companies can charge, of course. But aside from that, that follows instructions last week as well for government-sponsored enterprises, Fannie Mae and Freddie Mac, to purchase $200 billion in mortgage bonds, and that's aimed at driving down mortgage rates. So again, all of these policies, both of these policies ahead of midterms, and really quite interesting and something to follow underneath these sort of front and center themes as well. Just on the Fed chair announcement, the new Fed chair this is, of course, that is expected in the next week or so, next few weeks really, a successor to Fed Chair Powell, who leaves in May. List of candidates really greatly narrowed from that sort of 12 initial candidates. First up, and well, interestingly, Hassett was seen as the clear favorite to replace Powell. However, in recent weeks, we've had several reports that insiders recommending against his appointment, really. And really now we're sort of neck and neck on poly markets. That's the betting markets, which a lot of people look at for things like this. Now it's neck and neck, as I say. Hassett has a 38% chance, I think, last time I looked, and then Fed Governor Warsh is former Fed Governor Warsh, around 40%. So he's now the favorite. Warsh probably handicapped by his opposition to tariffs and QE, plus deep criticism of the Fed, actually, while Hassett probably faces the challenge that markets think he's probably too dovish, which could be bad for 10-year US Treasury yields, although probably that is what President Trump would like. So really interesting markets moving as they weigh up those two Kevins really, and who will be the announced successor to Fed Chair Powell, which is obviously very topical with these grand jury subpoenas. Finally then, let's just get to one quick theme which I want to bring up, which is the Takaichi trade to dollar yen, why that's been moving a lot. So bear with me 1 second. I'll just bring up the dollar yen chart, which you can see here. And this is all about headlines now. And now I think it's been confirmed that the Japanese Prime Minister will call a snap election, I think possibly now next month. The Takaichi trade is down to PM Takaichi being a fiscal and monetary dove, and that is bullish for equities because they expect more fiscal stimulus, which will boost the economy, of course, and that has helped Japanese equities hit record highs again today, I think, as well as yesterday. Yields have gone up very sharply in Japanese government bonds, JGBs. I think the 5-year yield touched a historic top actually overnight actually, and then dollar yen made a new high, you can see there, and we're firmly into intervention territory. If I just pull this back a touch, you can see that top from January of last year, 158.87, which we're just struggling to beat at the moment, and then you've got those highs from summer 2024, July 2024, just below 162. Lines in the sand here. Everybody's talking about because of where potentially the Japanese authorities may intervene. 162 then is that key massive area, otherwise sort of 160 around number as well. Interesting then, nothing so far, just verbal intervention, and it is quite rare that the MOF would do something generally, although it has done sort of in the last few years more often than probably seen previously. So yeah, just watch out for that. And news-wise, obviously, although we had I think confirmation of that snap election as well. Okay, moving on then, let's get into data then, and we had non-farm payrolls data, of course, and then we've had US CPI data. First of all, we'll go to non-farm payroll data. We just got a graphic there with the main numbers. This was Friday's monthly report, of course, the headline printing at 50,000 versus 70,000 expected, and then there were a net 76 downward revisions to the past 2 months of data. That means November is now 56,000 from 64,000, and October negative 173 from negative 105. Remember Fed Chair Powell, he suggested that officials believe the BLS, the Bureau of Labor Statistics, is overestimating payrolls growth by around 60,000 per month. So that essentially suggests the job market is now very stagnant. And looking over the past 6 months, actually, non-farm payrolls growth has averaged just 14,500. So if you adjust them for Powell's assessment on the measurement error, this implies actually that the US is losing more than 45,000 jobs per month. Moving on to the household survey, better news there. The unemployment rate that dipped to 4.4% from a downwardly revised 4.5%. Originally that was 4.6. And then rounding out the numbers, wage growth that came in at 0.3% month on month as expected, though the year on year was higher than expected at 3.8 from 3.6 in November. Just in the detail, really, I just wanted to get to that before I talk about pricing. It's just really interesting. We talked about this before. Composition of the jobs created, fully still very much concentrated in private education and healthcare services. 41 of the 50,000 jobs added was from those two sectors. And then over a 3-year period, since January 23, actually, this sector has accounted for 55% of the 5.2 million jobs added in the US economy, while government has contributed 20% and leisure and hospitality representing about 18% of all jobs added. So then when you look at all the other sectors, all those sectors which really do drive economic growth much more than those three, so tech, construction, manufacturing, business services, financial services, of course, retail, transport, logistics, they're responsible for only 7% of the job creation during that period. So in December, that grouping actually lost 51,000 jobs and has only seen 1 up month out of the past 8. So that is a really interesting detail, we think, and kind of reinforces the message about what the Fed is looking at or what they may look at going forward, of course, because of the need potentially for more support for the economy. Of course, the dip in that jobless rate and respectable wage growth, really, that does offer some mitigation, but the jobs market undoubtedly has cooled through 2025. Obviously, monetary policy then is still regarded as modestly restrictive, so that also then justifies possibly further gradual rate cuts. Interesting, markets then priced out any chance really of a January move. We were just below sort of a 1 in 5 chance before the non-farm payroll data, and then we've sort of gone down to 5% chance, and now we're virtually nothing priced in for then the January meeting at the end of the month, the Fed meeting that is. That was the NFP data, and you can just see there, this is the headline bar chart. 55,000 was initially expected, that went up to 70, and we got 50. So you can just see that compared to previous months. So yeah, NFP. Moving on to CPI data then, we got that out yesterday. Interesting, this is a chart really with the numbers from just before that data. You can see the 2% Fed target, and then obviously where we are with core and the headline. Really actually provided another soft inflation print really. Headline prices, they rose 0.3% month on month as consensus forecast, while core, they rose 0.2% versus the 0.3% prediction. So just a touch softer there. Some economists were thinking we would get a higher print of 0.4, actually, largely due to timing issues related to the government shutdown that really heightened the influence of price discounting later in November 2025 relative to normal November 2024, but that didn't happen. And really the key takeaway then from this inflation data, from all the price data, is that, well, it's to do with tariffs really, and that goods prices were very benign, and that underscores the point that tariffs have had a far more muted impact really on inflation than feared. If you remember when tariffs came in, everybody expecting price rises and the CPI to go up, and we haven't had that at all. Goods that are often imported actually and therefore subject to tariffs is the key thing to note, and that is then interesting because it suggests US retailers are squeezing their profit margins. So that'll be interesting with this Q4 earnings season just kicking off now, especially for retailers, which happens later on in the season actually, probably in a few weeks time. But Walmart, Target, all of these kind of discounters, not discounters, but big retailers, of course, in the US, whether their profit margins, some of these guys are seeing their profit margins squeezed. Just in terms of a little bit of detail on the CPI then as well, in terms of sort of sectors that continue to run hotter, the key primary rent and owners equivalent rent, that increased 0.3%. Transport services, due to a big jump in airline fares, that increased 0.5%. So the bottom line really interesting because we had a market reaction pretty subdued on a soft report. There is a lot of sort of statistical noise still potentially going through these numbers due to the government shutdown, but potentially it is quite a good outcome overall, and Powell certainly suggesting that the tariff impact hasn't got much further to run and could peak in this quarter. Really, that indicates that policymakers then may well be on chance to cut rates further in probably not January, of course, but later on through the first half of this year. Obviously, there is a bit of risk from tariffs still, but the fact it has come through slowly and much less forcibly than feared really gives the opportunity then for some other factors which are in the pipeline, so falling gasoline prices, slowing housing rents, and also softening wage growth generally, that could contribute to CPI falling or trending lower through this year, and then getting much closer to that 2% target towards the end of 2026. So yeah, that's CPI and NFP, pretty detailed look there, but very important numbers for what's happening going forward. Here is, yeah, just your guide actually from December and the latest dot plot, really the central projections. They are essentially, and I've arrowed there, just the core PCE number, so slightly different CPI, but just a reminder of what is the central projection from Fed officials going forward. Slightly lower, they were projecting, but not too much, and really not hitting that Fed target actually till 2027. So thought that was worth looking at as well. If we look at a DXY chart now, so bear with me 1 second. That is here. And you can just see how we've rebounded really. We got up to the 50-day, the blue line, and the black line, which is the 200-day moving averages there. The blue line, the 50-day, 98,908, and the black line, 99.04. Interesting because obviously the blue line crossed above the black line here, which is seen as a bullish signal, a golden cross, and that's probably where we got the rebound really, and now we're struggling around those levels. We've still got in here these dotted lines, one of them being a long-term low from 2023 and 99.57 here, and also a minor fib level actually of this move from the highs last year to the lows, and that first 23.6 fib levels at 99.51. Otherwise then very strong resistance above 100, and then you've got decent support if we do lose the 200-day moving average just below 98 before then this long-term trend line from lows from 2011 and 2021. If I just remind you there, look, which did hold previously. Here you can see lows from July and then in September, which are pretty decent support levels, you would think. That's a dollar. I just wanted to, well, we'll look at gold, but that's just another symptom of all those sort of geopolitical and other drivers which are pushing bullion, both gold and silver, much higher. Obviously, we've got geopolitical issues, safe haven characteristics of gold and silver as well. We've got Fed independence question marks, and we've got fiscal questions as well as central bank buying underpinning support for gold in general. Then you've got the dollar debasement trade, which is another story entirely, moving away from dollar assets and pushing into harder assets, and gold being a massive beneficiary. It just keeps on going higher. We're not really that overbought. You can see we've got much more overbought than previous pushes higher, so doesn't seem like we can't carry on going higher. Everyone's bullish is, guess, the only thing, and whether what happens if things turn around, say if stocks were to turn around and then we get margin calls, for example, and profit taking in gold, then you could see a dip, but there is a very strong underpinning of support, as I say, with all those factors helping gold at the moment. Okay, let's get into earnings now. Actually, before we get into earnings, sorry, we'll just look at some of the other data points, and so some of the other currency majors. Bear with me. So we've got the Aussie dollar here. We got inflation data out last week, actually unchanged in November, with the annual figure falling somewhat more than hoped, actually from 3.8 to 3.4%, with 3.6% estimated. Biggest contributor was housing, up 5.2%, and the trimmed mean inflation gauge, that's ignores the most volatile price swings really, and is what the central bank, the RBA, prefers to look at for core inflation. That showed prices rising by 0.3% and 3.2%, so from 3.3%. Annual goods inflation, that slowed from 3.8 to 3.3, mainly because of electricity prices. Services inflation, that's also slowed from 3.9 to 3.6. The issue though, or not the issue really, but the lower inflation print, sort of helpful, but really doesn't alter the market view that the RBA potentially will be raising the policy rate by the May policy meeting. Aussie dollar was up on that, and you can see that spike higher to, where do we get to, 67, 66, before then just dropping down below a previous, well, no, actually a minor fib level, actually, you can see there at 67.21, which capped the upside previously in September, and you've got that long-term high at 69.42 if we can get above that. Otherwise, the 50-day moving average below somewhat at 65.99. Also, moving on to another currency major, dollar CAD. Interesting chart this. Let me just expand it as well. We did get jobs data when we got NFP actually last Friday. The economy saw 8,200 jobs, new jobs created in December, that beating the estimate of negative 5,000, which comes after 3 months of outsized gains. The economy had a total of, well, it's added a total actually of 181,000 new jobs now from September through November, in contrast to almost no change in the first 8 months, when Of course, US tariffs and trade uncertainty was choking hiring, really. The unemployment rate, that rose to 6.8 from 6.5%, so above the expected 6.6 as more people search for work. Yeah, all in, unemployment rate suggests that there is still plenty of slack remaining in the labour market. And if we remember, the Bank of Canada, they held rates steady at 2.25% in December. And money markets really expect them to stay on hold for 2026, actually, which really the jobs data, this jobs data backs up. Potentially, if that does roll over, then possibly we get another move by the Bank of Canada, especially if the Fed goes as well. But that sort of slowdown has been reflected in CAD getting weaker, so dollar CAD going higher. You can see that after we dipped down to 136.42 in late December, we had consecutive days of gains really by the dollar, moved above the 200-day moving average at 138.39, and now we're just trapped or capped by the 50-day moving average, the blue line, that's at 139.00, actually 139 on the nose, and we're currently trading just below that. Looks like bullish consolidation. If we can push above there, then we've got a fib level at 139.50, which is a fib level of this high in November down to the recent low in December. So 139.50 to the upside, and then support around the 61.8 at 138.32. And the 200-day moving average at 138.39. Okay, moving on then finally to actually what's coming up, and we get Q4 earnings, of course. The season's just kicked off already, and we also get UK GDP data, so we'll look at cable shortly. Just on earnings then, just bringing up a chart here of what is expected at the start. Expectations to show continued but moderating growth. Annual earnings expected to rise 8.3% year on year, figure which would mark the 10th consecutive quarter of growth for the benchmark. Revenues are seen up 7.6%. That would not only mark actually the 21st consecutive quarter of growth, but also the second fastest pace since the third quarter of 2022. You can just see that here, that overall growth, as I said, 8.3% expected. On a sector level, expectations point to 9 of the S&P's 11 sectors chalking up annual earnings growth. Technology, you can see by far the biggest outperformer really expected, along with then materials, communication services, and financials. Flip side to that is consumer discretionary and industrials being the only two sectors in the red potentially. And consumer discretionary set to record the largest year-on-year earnings decline, actually weighed down by big declines in auto and household durables, all likely a reflection of consumers marginally pulling back on spending as the impact of higher prices continues to be felt. As is usually the way, then we're kicking off with financials. Wall Street major banks reporting this week. We began with JP Morgan yesterday, and then we get as well Citigroup, Wells Fargo today, I think shortly, before then Morgan Stanley and Goldman Sachs tomorrow. They will be examined generally, these bank earnings, because they're a very good barometer of broader economic performance and consumer spending, and then really they sort of set the stage really for how the remainder of the reporting season may progress. Credit provisions, they're likely to be watched closely with the big banks, but generally they are healthy due to strong M&A, decent M&A activity, robust economy really, regulatory environment remaining favorable, and then we have stable credit quality really, and pretty resilient net income. And that's why we've had the bank index actually roll into earnings season at a record high. Obviously, we did get JP Morgan's results, which were strong overall, even after a one-off hit, and kind of broadly supportive for bank stocks and the wider market, and kind of the soft landing narrative, if you like. Although JP Morgan was off over 4% to close yesterday. Generally, it's a big bellwether, of course. JP Morgan just focusing on that, and they did show resilient profits and decent loan quality, which can support the whole banking sector really. And of course, if JP Morgan's doing well, then that's kind of a green light for other banks, brokers, and regional financials as well, at least in the near term. JP Morgan, remember, is a heavyweight in the major indices, and that did drag on then the Dow Jones, a big component of that, dragged on the Dow Jones, which underperformed yesterday. Obviously, if other large banks do echo the sort of general positive theme, then that would reduce immediate recession fears, of course, be constructive for cyclicals and value, and not just, of course, mega cap tech going forward. So if we look at some of the indices then, just got the S&P just below, obviously, recent record highs. Just looks like we're going higher really, with strong support, probably not below now, down to, well, a previous high at 69.45, and then the 50-day moving average is at 68.22. The Nasdaq not really hitting those record highs just yet, so tech is still lagging. That high just above 24,000 on the Nasdaq, and we're at 23,709, with support probably around that 50-day moving average again. That's at 23,276. The Dow, as I say, that struggled yesterday on JP Morgan moving 4% lower. We did make a record high, but then turned lower. First support possibly around that previous December record high at 48,886, and then you've got the 50-day moving average, the blue line below that, then at 47,857, which is here. Let me just show you, sorry. Nasdaq here, blue line, 50-day moving average 25,335, that high at 26,182. S&P just below there, but the 50-day well below at 68.22, and then the Dow lagging and turn around yesterday after making a record high. So you've got the previous record high at 48,886, as I say, and then the blue line's a 50-day moving average at 47,857. Finally, yeah, we'll just quickly go to UK GDP data. Nothing really much out of the UK over recent days, actually. We just had Governor Bailey backing up Fed Chair Powell, but nothing other really major from the Bank of England. We do get GDP out tomorrow, and the output should rebound after October's fall, but the bigger picture, there has been a slowdown in UK growth through the second half of 2025. A lot of that down probably due to the November budget related uncertainty that hit already fragile consumer confidence, as well as really putting off big investment and spending decisions. And interesting, it has happened as a sort of seasonal thing as well now, has happened every year since 2022, with the GDP data being much stronger in the first half of the year than the second. So as I say, seasonal adjustment issues possibly in the data, but of course November budget issues specifically towards probably the data we see on Thursday. This is just the BOE path at the moment, and inflation way too high really, and above the inflation target. So an issue for the Bank of England with stagflation, possibly with stronger inflation or sticky inflation really, and growth being fairly stagnant. Just for cable though, that's been doing pretty well recently. If I just pull up that chart as the last one to look at, just bear with me 1 second, which is here. Yeah, cable sort of bouncing off that November low at 130.10, got up to 135.67, and we're just being supported now by the 200-day moving average, that black line at 133.92. We're also at the halfway point of this move from that high in when was it? In start of July, down to this move here in start of November. So you've got the halfway point at 133.97. And then we're between sort of fib levels, 130.60 to the downside, and then 134.88 to the upside, with that cycle high and the year-to-date high at 135.67. Okay, we'll wrap it up there. Thank you so much for being on the call. Really do appreciate it. Hope that's proved of use to you guys. Don't see any questions. So yeah, watch out. Lots of things going on. Lots of multiple different drivers going on. Not so much sort of data really now and central banks really, but geopolitical issues, of course, are plenty, which are driving a lot of different assets. Take care, and we'll speak to you in a couple of weeks.